Good afternoon, everyone, and happy spring, assuming I can say that with confidence, which could be up for debate. Welcome to our quarterly webinar. My name is Lauren Rudolph Hesselton, and it's a pleasure to be hosting today's discussion. I am an investment counselor here at Kerr, and I've had the pleasure of being on the team for the past 13 years. I'm joined today by our CEO, Krista Kerr, and our Senior Investment Counselor, Frank Settino. They will walk us through first quarter market developments and review key themes we expect to shape the remainder of the year. Now, I don't know about you, but just one quarter into 2026, and it already seems like we've lived through an entire year of market headlines. Today's session is designed to cut through all the noise, focus on what truly mattered in Q1, and clarify how shifting market trends are shaping the investment outlook. So this is the agenda we'll follow today. And please note you may submit questions at any time using the Q&A icon at the bottom of your screen. We will do our best to address all questions during the Q&A portion at the end of the session. Before we move into Krista's market review, I'd like to briefly introduce Kerr Financial and our investment philosophy, particularly for those of you joining for the first time. So we are a discretionary portfolio manager, which means our firm is governed by a fiduciary duty to act in the best interest of our clients. Our approach to investment management is anchored by three core principles. The first is a disciplined focus on long-term investment objectives. The second is deep diversification across not just asset classes, but regions, sectors, investment styles, and beyond. We view diversification as having multiple arrows in the quiver, each intentionally crafted for different market environments and risk scenarios. And finally, we place strong conviction on our platform of multi-manager investment solutions, through which we diligently select and actively oversee best-in-class investment strategies. Together, these tenets allow us to construct investment portfolios in a flexible, resilient, and independent manner. This approach is especially valuable during periods of heightened uncertainty and rapidly evolving market conditions. First speaker today, she is the CEO of Kerr, and she's responsible for our firm's overall leadership and strategic direction. She is an accomplished leader and holds multiple professional designations, including the CFA. Krista serves on our investment committee and leads the firm's multifamily office division, which specializes in multi-generational wealth stewardship for ultra-high net worth families. Krista is a recognized thought leader in Canada's MFO community and is frequently featured in industry publications for her insights. Krista will be followed by Frank Settino, who leads the firm's investment management division here in Montreal, is the chair of our investment committee, and serves on the senior leadership team of the firm. Frank is a 30-year industry veteran, a chartered financial analyst, and he began his career in Canadian equity analysis at a major institution. He transitioned into private wealth management when he joined Kerr back in 2015. Frank brings deep capital markets expertise and a highly disciplined investment approach to our clients. So with that, let's begin. Krista, I'll invite you to turn on your video and microphone and take it from here with our first polling question.
Thank you very much, Lauren. Just before we go into the polling question, I'll just make a little introductory comments. Welcome to all of you. As Lauren mentioned, we are in a period of rapidly evolving trends and headlines, and everything is quite fluid. At the moment, we're sort of keeping an eye on whether talks between the US and Iran will progress forward. So the markets are reacting to that again this morning. But there's been a couple of key themes that everybody's looking at through the first quarter. One of them, obviously, and probably the most important, although maybe we'll get into what you think are the biggest risks, but definitely the conflict in the Middle East has been dominating a lot of discussions. Sort of what that means for energy prices and inflation and global growth has been a big theme, and we're going to talk about that today. There's also still a lot of discussion around AI disruption and what that means in the short term to the price of certain stocks, but also in the long term. And we'll talk a little bit about that. And then the other discussion point people have been talking a lot about this quarter and even the end of last year was private credit. So Frank will be addressing that in his remarks. We thought these were all themes that people would be interested in. As we usually do at the beginning of these sessions, we wanted to get a bit of feedback from you as the participants. So our first polling question, which you'll see on the screen, is what do you see as the biggest market risk today? Is it geopolitics broadly, including the conflict in the Middle East? Is it inflation remaining elevated? Is it slowing economic growth, monetary policy, and the possibility that central banks will make an error in how they peg monetary policy, or AI disruption risks? So if you can take a moment and answer that, and then we'll read that back and see how it plays into what we're talking about today. So very much unsurprisingly, 82% of you feel geopolitics, including the conflict in the Middle East, is the biggest risk. We have 14% who see slowing economic growth as a big risk, and 5% looking at AI disruption risks. I think it's interesting because they do have interplay, these things. It might be that the risk of stagflation, which is slowing economic growth, potentially to recession and higher inflation, could be the biggest risk. But the catalyst for that could be the conflict in the Middle East. It's not our central case at the moment, but looking at how long that conflict lasts and how much disruption there is to energy infrastructure could lead us to worrying about that potential for stagflation, which is really a combination of 2 and 3 on this slide, and that would be a bigger risk to the economy and the markets. So I think all of those play into what people are worrying about. We'll talk about that. AI disruption has some short-term disruption to stock prices, but also may end up having some positive impacts. So we'll talk about that as we go through the slides. So we wanted to start thinking just what were the main themes and where did we come from? Some of you may have been on our I think it was January 27th quarterly comment webinar that we had. And at that point, we did recognize a lot of risks, including a number of geopolitical risks as sort of a tail risk to the market. But overall, we were feeling cautiously optimistic or cautiously constructive, I would say, on the outlook. And that was based on the fact that we saw modest but stable growth worldwide. We saw positive earnings. We saw inflation trending lower. We saw rates that were going to trend lower, even though at a slower pace than we originally had anticipated last year. And there was the positive impact from AI capital spending. So some of those factors are still in place, but generally we saw that constructive outlook with some tail risks around geopolitics. Now, as we know, that didn't exactly play out. We then had, a military action in Venezuela, which was a short piece of action. And then we moved to the current conflict in the Middle East. So the quarter at the end was really defined by a number of things we've listed here. So geopolitical risk being brought to the forefront, no longer a tail risk. Energy shocks coming out of that, energy prices up as high as, $118 per barrel, now at 98, I think this morning. policy uncertainty, so central banks being uncertain as to how to respond to such a supply shock to the energy prices. So some uncertainty about direction of interest rates, and then all of that leading to a rotation in where market returns came from, which we'll talk about. We saw oil and commodity prices go up. We saw equity markets generally down, except for certain sectors. And the promise of cuts in interest rates was pushed further out than we had thought before, and we saw a lot more volatility in the quarter. So lots of uncertainty in there. We'll anchor that as to where we think the markets are going to go, but that's sort of the main themes of what happened in the last 3 months. So geopolitical landscape, this isn't surprising to everybody. As I mentioned, that risk that we saw, there were a lot of risks that everybody has been monitoring, but they moved from being a potential tail risk to being a primary market driver with the conflict that happened in the Middle East, or that is still going on in the Middle East. So the biggest impact has been that has led to serious energy shocks, with the fact that over 20% of oil and natural gas move through the Strait of Hormuz that we've been hearing so much about. And that has led to shocks in the energy market, and disrupted supply chains, and Brent crude has surged even higher than what we mentioned on this slide, but up about 85% over the year. So the orange line, the one at the top, is Brent crude, and the blue one is WTI oil. So both measures of the price of oil, and you can see what a sharp increase that was over the period in the month of March. We also, behind all of that, still have uncertainty around the level of tariffs and trade tensions around the world. So there's a lot of uncertainty around the geopolitical landscape. That has, as I mentioned, led to greater volatility. Now, we've been really, we've remarked on the fact that investor sentiment generally has been a lot more resilient than people thought it might be. Through last year, where we had all of the trade uncertainty and the tariff introduction, and also through the beginning of the year with conflicts, investor sentiment has held up pretty well, and people have stayed in the markets. But we are seeing that being tested now. You see with energy prices where they are, concern around how that plays into everybody's inflation, and also impact on labor markets. All of that is starting to test investor sentiment. I thought it might be interesting to just pause a second on the VIX index, the volatility index. I don't know if people are all familiar with how that's measured, but across the bottom of this slide, you can see when we have a 0 to 15 in the VIX, that's very low market volatility, with lots of optimism being signaled. If you have 15 to 20, that's moderate volatility. 20 to 25 is medium. 25 to 30 is high. And anything above 30 is extremely high, indicating turbulence in the markets. So that's sort of right from the index makers' definitions. If you look above, we can see what happened in the last year. And you can see in May last year, we had a lot of uncertainty and volatility, and that was following the tariff announcements and real uncertainty as to how trade tensions were going to play out in the world. Then things sort of calmed down into a more moderate range for a period of time. But you can see really in March and April of this year, we're again testing those very high levels of volatility. And we anticipate that volatility is going to continue until we have some resolution to the conflict. We certainly hope that we see peaceful resolution before too long. It will depend a little bit on getting people to the table and what happens. Hopefully that will happen before too long, but until that happens, we think we'll continue to have volatility. And that gets into, we'll talk a little bit later about wanting to stay patient and not react to all of that volatility on a daily basis. So thinking about the markets themselves and what happened, and this is probably not news to everybody, but in the equity markets, the biggest thing that we had, and sort of the second, third, and fourth bullet all sort of play into the first item there. We had a real rotation of where returns were coming from what we'd seen in prior years. And that we've talked about a couple of times before, but really we had growth stocks, those quality growth, large cap stocks were coming under some pressure, people taking some profits in the mega cap IT stocks, for example, and then value and real assets outperforming the more cyclical end of the market. So seeing energy and materials outperform. So that rotation in style from growth to value happened. And then in terms of equity sectors, you could see that there was some profit taking in the mega cap tech sectors, which were the ones that had led so much before, and energy, industrials, and materials really leading during the quarter. So all of that sort of is the rotation that we saw in the market, and you'll see when we look at sectors what that meant. Also, AI is still a long-term theme. There are some stocks that were challenged by what the market perceived as vulnerabilities to AI disruption. So in the short term, there was some impact of that, and the longer term, there's some optimism from the productivity that can come from AI. So part of what we think when we see all of that happening goes back to what Lauren was talking about. It enforces the importance of being diversified in our portfolios because there is that rotation from time to time. Being diversified means that maybe you're diluting, one of the styles when it rises up, but you're not going to be hurt as much by the other style moving. So I think having drivers from different kinds of styles really can help support the resilience in a portfolio. On the fixed income side, we had bond markets adjusting to the fact that they're anticipating delayed rate cuts. So the fact that rates may stay where they are longer was an adjustment for fixed income markets. So they didn't act as a ballast to the equity pressures that were felt in the quarter. There was also some pressure on fixed income. The shorter duration fixed income outperformed longer term credit, and quality investment grade credit did better than less investment grade. So I think again that strengthens our commitment to positioning with shorter duration fixed income that is high quality. And so we do get challenged when people say why does the fixed income still have a place in a portfolio when it's not acting as much as a hedge against equity market movement. I think there's a couple of reasons. First of all, it provides income to the portfolio. It is a little bit more stable than the equity returns. It should also, if we do have a stagflation or recessionary scenario, which is not our main case, then fixed income would certainly hold its own at that time. So there are reasons to have that. And then within that sector, that section of the portfolio, we want to have shorter duration, higher quality credit. So if we look at the next, we've got our same 3 slides. We often use this as a slide showing asset class returns during the quarter and prior periods. You can see on the left-hand side, as you're looking at it, you've got cash returns, which for the quarter were only 0.5%. That ties into, the Canadian prime rate being held at 2.25 by the Bank of Canada. So you can see that rate coming down. We're going back not to the zero interest rates that we had, but to lower interest rates. So the reason to hold cash is not to have high interest rate returns, but really to have liquidity where you need it and safety, especially if you have short-term liquidity needs. The bond universe, as you can see, was fairly flat in the quarter, 0.2%. 0.8% over the past year. So not a lot of return from that sector, a little bit better if you were shorter duration corporate than that, but not a lot of return coming from that area, but not negative. The Canadian equity market's holding up better than other markets because of the fact that we have a lot of energy and materials in Canada. So you can see for the quarter, the TSX was up 3.9%. For the 1 year, 34.8%, the 3.9, reflecting a lot of the energy returns, the 34.8 reflecting the gold returns we talked about on the last webinar. And that has brought the longer term returns, the 3-year and 5-year, up to higher levels from Canada. In the US, and this is all in Canadian dollar terms, these numbers, the market was actually down 2.6. I think it was down 4.3 in US dollar terms, but the US dollar got a bit stronger against the Canadian dollar. So down 2.6 in Canadian dollar terms, up 14.2 for the 1 year before that. And that's really that rotation out of some of those big tech names that had been leading, impacted the quarter. And you can still see the positive impact of those returns in longer term bases. The international markets outside of North America were up 0.7% for the quarter, 18.2 for the year. And emerging markets were up 1.7% for the quarter and 26.3% for the year. So all of that, if you bring it together to the balanced benchmark we use, which does reflect 30% weight in Canada, so it's got a bunch of the Canadian weight in that benchmark, is a balanced portfolio being up just about 1%. So slightly positive if you had that weight in Canada. Portfolios with more non-Canadian holdings would have been slightly negative or just below in terms of indices. So that's the asset class returns. The next slide is the industry sector returns. And you can see, not surprisingly, energy being the strongest return. This is actually US dollar, US sectors in US dollars. So the energy sectors were up 38.2, materials up 9.7, utilities up 8.3. So those cyclical sectors doing best. And you can see on the other end here showing that rotation that we had technology down 9.1%, consumer discretionary down 9.2%, communication services down 6.9%, financials down 9.3%. So a real rotation out of what had led in some prior periods. And the next slide shows the same thing in terms of investment styles. So you can see during the quarter, which is the more faded bar, you can see that quality and growth. Quality was down 3.7, growth was down 8.4. Those had led a lot in prior quarters. And on the other side, you had high dividend stocks up 4.4, value up 1.3, small cap up 1.4. So again, that rotation that we were seeing that makes us want to embrace diversification in the portfolios. So to go back a little bit as we look at what does this all mean for the outlook going forward, we're thinking a little bit about the macro backdrop. So as I mentioned a few times, our central case is still not for a recession in the current year, but we need to keep an eye on that duration of the conflict in Iran and the extent of damage to the energy infrastructure, because if those get really impacted, that could stretch this conflict out longer, which could slow things down more. But assuming we come to some resolution in that area before too long, we think that we're not going to be hit with a full recession this year, but there are a little bit of headwinds to global growth. The International Monetary Fund revised their forecast down, projecting global growth at 3.1 in 2026, with a modest recovery to 3.2% in 2027. This heat map, you can see there are fewer countries that are very dark green, signaling that they are looking for very big growth. You can still see the dark green in India and certain areas in Africa, for example, and a little bit darker in China. So there are some areas that are seeing a little bit greater growth, but there's a lot of the developed world in this light green color, including North America and a lot of Europe, and that would be a 0 to 3% growth expectation in those areas. So all of that sort of coming together to 3.1% growth. You can see those few areas, Iran particularly, being hit with an expectation of negative growth. So the conflict, as we mentioned, has really caused a sharp rise in oil prices. Oil prices do impact inflation. So where we saw inflation moving in the right direction coming into the year, although some sticky areas still, we're now seeing some near-term pressure on inflation because of energy. If you think of energy as part of your headline CPI index or headline CPI measure, it's about 6.5 to 7.5% of that measure. So it's not 50% of it, but you can see here, based on this US Bureau of Labor Statistics chart, that most other items are in the sort of 2 to 3% or 2 to 4%, 2 to 3% range of inflation, which is sort of where we were before. But energy has now ticked up to over 12%. And so that's putting some upward pressure on the full CPI indexes. That conflict has led to higher oil and natural gas prices. It's led to higher second order impacts like some of the fertilizers and other petrochemicals, and that is lifting inflation for households. There's been a lot of talk about, do we think this rise in energy prices is like the 1970s shock? And it certainly is another strong shock that exists. However, there are quite a few differences, that OPEC Plus is a lot larger than it was then. The US is a lot more independent with their shale production and their own energy efficiency. So perhaps not quite the same backdrop as we had in the 1970s, but certainly some impact on inflation from a supply side. And so that has all led central banks to have to reconsider what they're looking at. And I think it's a harder job for central banks now because of the fact that this is a supply shock, not a demand shock. If you have people that are, either spending too rapidly, so prices are going up, you could cool that market by raising rates. A demand side shock is easier to manage with rates. With a supply side shock, it's a little bit harder to do that. So what you can see is a lot of central banks have really held steady in terms of their rates. The U.S. Federal Reserve is holding steady in that sort of 3.5 to 3.75% range. The Federal Reserve or FOMC participants are looking at maybe one cut in 2026 and another in 2027, if that. So a lot less cuts and longer, more deferred timing than we looked at before. The other markets are also the same. So Bank of Canada held its rate at 2.25. Bank of England held its rate at 3.75. The European Central Bank held their rate around 2%. So everybody's sort of holding to see what's going to happen. And you can see this chart shows the dot plot, as they say, shows what the committee participants are thinking. And you can see a pretty flat expectation of where rates are going to go even out to the longer run. So rates may be staying in the range they're at around 3% rather than coming down a lot faster. So that's something that's a little bit of a change. We had already talked last time about the fact that we were going to see fewer cuts and they were going to take longer to implement, but this is even showing that trend a little bit more. So that all sounded like very difficult news. So we do have this uncertainty that we're keeping an eye on. We do have inflation that's now stickier. We do have central banks holding on rates, all of those things that are providing near and midterm impacts on the market. On the one hand, we understand all of that, but we do see that a lot of that has been priced into the market as of the end of February and into March. And there are some factors that are still positive when you look at investment markets. I'm saying still that we think negotiations are continuing in the Middle East. Hopefully that is going to happen. We have that end of the ceasefire date by the end of the day tomorrow, but we'll see. Hopefully they keep talks going. The biggest thing I think that's a positive, and it's the similar factor to what we talked about before, is analysts are still projecting low double-digit corporate earnings growth. Some of the U.S. banks, the big banks, came out even saying they're expecting a little bit stronger earnings growth than they had anticipated before. So that's still positive news. There was also some news yesterday that college graduates are finding jobs a bit faster. So there is some positive news in terms of the economy. And then we still have that momentum coming in from companies and governments spending money on energy transition and AI projects because of the positive impact that AI can have going forward. So that extra capital spending and the high earnings are still really positive for the longer term if you go out past this near term uncertainty. And I think with AI, large language models and technology more broadly, those are going to lead to productivity and innovation. There's some disruption along the way in terms of jobs. There'll be some jobs that don't exist, but other jobs that do. There'll be some companies that have to change and adapt and that might be disrupted, but there'll be other opportunities going forward and greater productivity in the workforce. So that's generally a positive. And if you think about it, the innovation is crazy. You think about Artemis and going, further than we've ever gone towards the moon. You think about driverless cars. You think about large language models in AI. There's a lot of innovation out there that is positive when you go out longer term. And then also because of market disruption, valuations have come down to more reasonable levels. So in some cases, there will be some better entry points. It's still good to be patient putting new money to work, but we're probably at a better time to invest at some point than maybe last year when markets were very expensive. So there are some bright sides, and we have to think of both that uncertainty and risk we talked about and some of these long-term factors as we position portfolios, which is the next slide. So because of that longer term thought of some supportive factors for the market, we continue to have our portfolios positioned in favor of equities, not only equities, but with more equities than fixed income or cash. That's to take advantage of that upside, as well as having, companies that can absorb inflation. If, that corporations can be a good hedge for inflation too, because you can often see inflation passed on through pricing. So I think we want to be positioned in favor of equities, but because of the greater uncertainty, we're raising cash in some portfolios where people have short-term liquidity needs. So we want to make sure we're not caught out by that. If you are someone who draws regularly from the portfolio, we'll likely have raised more short-term cash in the portfolio, not trying to time things, but trying to make sure we have cash at a time that you would need it rather than having to sell at a difficult time. Within the fixed income side, as mentioned, we're looking at shorter duration, higher quality. And then within the equity portfolio, we're staying really diversified, both in terms of factors, asset classes, and across industries within the strategies we're using in portfolios. We think that's the best way to have a resilient portfolio going forward. And overall, we want to be patient and not reactive. Markets are really moving quickly based on headlines, and I think you need to be patient and stick with a long-term plan. Of course, we need to keep an eye on whether some of these developments will get worse and whether we need to reposition, but you don't want to react to every daily headline, and you want to stick with the plan. So that's sort of where we are in terms of our understanding of the markets and how we're positioning, and I'll pass things over to Frank now.
Good afternoon, everybody. I will start my presentation with another polling question that will test your knowledge of some earlier comments that Krista made. So the question is, what alternative asset class has attracted the strongest inflow of assets from high net worth investors over the last 5 years? Is it A, real estate, B, private credit, C, infrastructure, or D, private equity? So we'll wait for the responses from the audience. This asset class has been in the news quite frequently over the last couple of years, but I would say more recently it's been more bad news than good. But it has been definitely topical in terms of conversation with some of our clients about the impact that this asset class has had on markets. So we'll wait for responses from our audience and see what the results are. And here we are. So the overwhelming response, 62% was private equity, followed by 24% private credit. Real estate got 10% of the vote, and infrastructure 5% of the vote. So if we can move to the following slide, it kind of gives you the answer to the question. So the asset class that's really benefited a great deal from inflows has been private credit. So as you can see from this chart from JP Morgan, assets under management have grown from under $100 million to close to $250 billion for private credit. So private credit has been a real beneficiary from investors adding to that capital flow. So which brings us to, I guess, our two topics for today. Obviously, first will be private credit. And really, we're going to try to paint a picture of the phenomenal growth private credit has experienced recently, but also touch on the concerns of rising redemptions that we've seen in the first quarter and concerns that it might create contagious effects for the broader financial system. The second topic we'll touch on it will be a subject that we think is going to grab a lot of headlines in the next few months, and that is the upcoming IPOs of SpaceX, OpenAI, and Anthropic. Given the size of these public offerings, we expect it's going to create a lot of risks and opportunities for investors. So let's jump to the next slide and our first topic, which is what has rattled private credit markets recently. Before we dive into the issues that have plagued the private credit managers, we want to provide some perspective on what is private credit, what factors have influenced it to experience massive growth over the last decade and a half, and how it differs from investing in public credit markets. This chart provides some context on the growth in private credit markets. Private corporate loans totaled $310 billion in 2010, and you can see it grew more than tenfold over a 15-year period to 3.5 trillion in 2025. And Morgan Stanley is forecasting the asset class to grow to 5 trillion by 2029. Now, private credit refers to loans made by companies, to companies by institutions other than banks. So some of the largest private credit managers, such as Apollo, Blackstone, and KKR, they've been managing these strategies for decades. But demand for private credit really blossomed following the great financial crisis. So that period was really a catalyst both for companies seeking loans and investors interested in credit markets. Following the near collapse of financial markets in 2009, what regulators did was they moved to tighten lending standards to traditional banks, forcing them to reduce exposure to mid and small sized businesses. Investors, on the other hand, were faced with very low yield prospects from public credit, while recognizing that there was elevated risk tied to rising interest rates. This is where private credit moved in to fill a need for both borrowers and lenders. Institutional investors such as pension funds and insurance companies were the leaders into the space and continue to represent an overwhelming part of private credit markets. For investors, private credit provided higher yields and lower volatility than public credit. Private credit also has attractive features such as floating rate protection, allowing investors to benefit from rising interest rates, while also maintaining senior secured positions from a creditor perspective. For companies, private credit provides them with greater ability to establish terms with lenders tailored to their situation, with flexible covenants and the ability to access capital in a very timely manner. Private credit has been far more accepting of lending to technology and service companies that lack the collateral and hard assets that banks typically look for in counterparties. Technology businesses, such as software companies, have assets tied to intellectual property. So therefore, it's no surprise that these companies that experienced strong growth over the last decade have become reliant on private markets. The next slide highlights four characteristics that are distinct between private and public credit. First is liquidity. Public credit offers liquidity with next day settlement. For private credit, depending on the investment vehicle, it ranges from no liquidity to predetermined liquidity queues on a quarterly basis. This is the characteristic that it by far is the most important and the one that investors need to be aligned with to earn expected returns from the asset class. The second is valuation. Public credit has a degree of transparency on pricing, with brokers willing to offer a stated price they're interested in buying and selling a bond issue at. There is no active market for private credit, and valuations for a loan can be priced drastically different by two different investors. Third is regulatory scrutiny. There is strong oversight and enforcement to abide by security laws by regulators in public markets, whereas private credit investors don't have the same standards. Lastly, U.S. corporate bond markets are predominantly a fixed rate market, exposing investors to interest rate risk. In contrast, 90 to 95% of U.S. private credit is based on floating rate, offering investors a different risk profile. Now, how has private credit performed for investors? And the next page provides some details. This chart highlights the annual returns for the Cliffwater Direct Lending Index and the Bloomberg U.S. Corporate High Yield Index from 2010 to 2024. So over a 15-year period, that private credit index returned a 9.2% compound annual return, vis-a-vis a 6.4% return for the Bloomberg index. Therefore, private credit index investors were rewarded with a 2.8% return premium to compensate investors for the illiquidity they incurred by investing in private markets. What's also very notable on this chart is in 2015, 2018, and also in 2022, when markets experienced negative returns, the Cliffwater Index generated a positive return, which is possibly an appealing aspect that attracted investors into the private credit space. Following the success institutional investors had with private credit in the 2010s, there's been a trend in new investment vehicles created to extend the reach of private credit to high net worth investors. The next slide provides some description on the different vehicles that exist, and it ranges from publicly traded business development corporations to evergreen funds, and how they differ in terms of liquidity, pricing, and the redemption process they each offer investors. The point we want to emphasize is that private credit managers purposely created vehicles for high net worth markets that attempt to provide a degree of liquidity that was largely absent in strategies created for sophisticated long-term institutional investors. Recall from the chart from our polling question that showed that explosive growth in private credit asset flows following the pandemic. During that period, high net worth investors were seeking stable yields when interest rates were at historical lows and there was a great deal of uncertainty. Given the strong historical returns, it's understandable why private credit became the hottest asset class. Now, let's move to the next slide that brings us to today, where we're witnessing a growing number of investors requesting material redemptions from private credit funds. In the first quarter, there was an historic surge in requests, totaling $20.8 billion. Most of the managers did not meet redemption requests and capped them at 5% of net assets. So, what is contributing to this turmoil in private credit markets? Well, first, we're witnessing several small and mid-sized businesses struggle with the higher interest rate environment that started to take shape in 2022. This has had a negative impact on both equity and credit valuations. And as profit margins have faced numerous headwinds ranging from inflation to higher tariffs. Second, there is growing bearish sentiment about the disruptive nature of AI and how the technology is going to threaten the profitability of software businesses. As we highlighted, private credit has been a key financier for the technology space, and it's estimated that private credit markets have 20 to 30% exposure to software and technology. With the growing concern about software companies' viability in an AI-dominated world, high net worth investors are rushing to the exits with redemption requests. The unorderly scenario taking place in private markets is causing sentiment to deteriorate, and more broadly, raising questions whether a liquidity shock in private credit markets could have negative implications for financial markets. On the next slide, we've highlighted key observations from research published by JP Morgan that puts the current situation into perspective. First, JP Morgan analysts note that fundamentals for private borrowers have stabilized in relation to default rates, interest coverage ratios, and growth rates. Second, and this is a key point, they don't believe further weakness in this market will threaten systemic risk. Private credit represents 9% of corporate loans. The risk profile is relatively unchanged to the overall US economy, and 80% of the investor base is held by institutions who are long-term investors and unlikely to react to news flows. Third, banks are lenders to business development corporations, but it only represents 12% of total lending, nowhere close to the 53% exposure banks had to real estate during the financial crisis that created systemic problems for the financial system. Lastly, while AI is truly a disruptive force, JP Morgan concludes it will not trigger a default rate. It won't trigger default rates to skyrocket next quarter or next year. It will be a development that will take some time to form. The key observation we want investors to take away from what's happening in private credit markets is to appreciate that any liquidity terms associated with private assets are only truly tested in periods of market stress, when all investors are seeking to have access to their capital. We've seen this occur in Canada with several alternative investment managers invested in real estate, mortgages, and in loans that have encountered a period of weaker valuations that's forced them to either limit or suspend redemptions. This highlights the need for investors to do their homework to understand the mechanisms that support any form of liquidity offered on strategies that are investing in illiquid assets. Now, let's move to our next topic and what we believe will be making a great deal of news this summer. Markets are expecting the initial public offerings of SpaceX, OpenAI, and Anthropic in the second half of 2026. These are massive corporations that collectively have valuations totaling $3 trillion. To put that into perspective, the valuation of the three would be larger than the entire market capitalization of the German stock market. The SpaceX IPO will rival the Saudi Aramco IPO, which was the largest IPO in history, while both OpenAI and Anthropic are at valuations many multiples larger than the largest in history. Equity markets have not seen companies this size become public entities in such a short period of time. The next slide provides a profile of each company and some of the key characteristics. SpaceX is led by Elon Musk, that has assembled a number of different businesses under the SpaceX umbrella. Its core business, Starlink, provides high-speed satellite internet to over 10 million subscribers globally. SpaceX also dominates the launch missions market, with clients ranging from commercial satellite companies to defense departments. The visionary space travel business is seeking to provide space exploration to a wider market. OpenAI was originally a research lab that has transitioned into a diversified AI conglomerate. It's led by Sam Altman, and its core product, ChatGPT, has over 1 billion weekly active users. It's also developing software and hardware products that are supporting its AI ecosystem. Anthropic was only founded 5 years ago and led by former OpenAI executives Dario and Daniela Amodilla. Anthropic is an OpenAI competitor, and its large language model, Claude, is positioned as a safe and reliable alternative to ChatGPT. It's largely focused on enterprise models for the finance, legal, and healthcare industries. A couple of observations from this table. First, all three are experiencing high growth rates in 2026. The second observation is that the valuations on a price-to-revenue basis are quite elevated, which perhaps explains why investors are listing shares publicly. To provide some perspective, NVIDIA is the S&P company trading at the highest price-to-revenue multiple at 39 times. Anthropic is at a 10 multiple premium to NVIDIA, and SpaceX is nearly twice the valuation at 73 times revenue. The next slide highlights what investors should be watching for as these IPOs come to market. First is market reception. There's no shortage of hype on the prospect for these companies, but it will be very interesting to see how well their valuations hold up as a broader audience of investors get the opportunity to bid on shares. A positive market reaction will likely lead to more private companies entering public markets, creating a change in the investment landscape. Second is market reception and how it will influence the valuations of a peer group of companies, such as Alphabet and Meta, and hardware companies like NVIDIA and Broadcom, who are supplying chips and building the powerful tools some of these companies are creating. There's also direct exposure for some companies. For example, Microsoft owns 27% of OpenAI, Alphabet has a 7% stake in SpaceX, while Amazon owns shares in both Anthropic and OpenAI. Third, given the size of these companies, they will eventually be added to market indices like the NASDAQ 100 and the S&P 500. This will create incremental demand for shares from exchange-traded funds. There's a lot of pressure on index providers to have this happen sooner than usual, given how large and influential these companies are. Fourth, these are high-growth companies that are spending heavily on artificial intelligence infrastructure and space exploration. Strong valuations will provide them with the fuel to continue financing these projects. But if valuations weaken, it could weigh down or slow down spending plans. On our last slide, we want to end off with research from one of the most prominent researchers on IPOs. So Professor Jay Ritter at the University of Florida has one of the most exhaustive databases on the performance of IPOs. With decades of research on IPOs, there are three observations we think are worth mentioning. First, technology IPOs have historically been underpriced. Therefore, shares typically rally quite strongly on the first day of trading. So, observing over 3,000 technology IPOs from 1980 to 2024, the average one-day return is 31%. The second observation is holding shares in IPOs in the subsequent 3 years has generated lackluster returns. Though the IPOs have generated a positive return just shy of 22%, the return has underperformed the broader equity market by almost 13% on average. The third observation from Professor Ritter is that he's noted a material shift in both profitability and valuations of companies that go public. In the 1980s and 90s, the majority of companies that IPO'd were profitable. Today, 80 to 90% of companies do not generate a profit. And in terms of valuation, the professor's research notes extreme multiples on a price to sales basis on IPOs, similar with what we've highlighted. And the general observation is that over time, as a public company, multiples do contract. We're really looking forward to the launches of these IPOs later this year that we think are really going to have an impact on markets overall. That's the end of my presentation. I'll now pass it back to Lauren for questions.
Very interesting
Thanks.
topics, Frank.
Yeah, thanks, Frank. Thanks, Krista, for your thoughtful insights and timely wisdom. Well, your mics are open. I see that. So both of you are here as we move into our Q&A session. I'll start with our first question, which ties into the first polling answer at the start of the webinar when 82% of listeners expressed that geopolitics and the Iran conflict are top of mind in terms of market risks. So the question is, with geopolitical risks and energy shocks dominating headlines, how does Kerr distinguish between risks that require action in portfolios versus noise that investors should ride through?
Maybe I can start on that and then we'll see if Frank wants to add. I think, as I mentioned, I think in my comments, the markets are really reacting strongly to up and news, all headlines, whether it's going up or down. I think more so than in the past. I think you're seeing sharp rises and falls all the time. I don't know if that's a factor of more retail investors in the market that are digesting the headlines, or that and things like CTAs and more technology trading. But we're definitely seeing big swings up and down based on everything people hear through Truth Social or through headlines, etc. So I think that's the noise that we try not to react to. I think that's not sound to really react daily. I think what you need to look at, what we're thinking about with this is, will this conflict in the Middle East last a lot longer? Will there be serious damage to the energy infrastructure that's going to really impact global growth for a longer term period or inflation for a longer term period? That's an important thing to think about, but not the daily moves and the threats from one side of the negotiation to the other, because sometimes those are positioning kind of comments. So I think we try not to react to the daily news, but to really understand the underlying. Do you want to add to any of that, Frank? Or
Yeah, no, I think the point I want to make is touching on the longer term. We want to make sure if we do make any changes, it reflects a longer term view and the
yeah,
potential that it changes our view. So if we think that the situation is going to impact the longer term and we want to kind of adapt the portfolio to that longer term possibility, then we'll make a change, but we won't react to the daily swings that are happening. It appears more frequently now. And making changes to which probably won't be very worthwhile because of the constant change that we're seeing in markets.
exactly.
Thank you both. I'll move on to our next question. This is a thoughtful one about rotation. So we've seen a sharp rotation away from growth assets towards value and real assets like commodities. Do you view this as a short-term adjustment or part of a longer-term shift in market leadership?
Hmm. I mean, I think again, there's always going to be times when different factors lead the market. So right now we are going to see a little bit of probably continued strength in the sort of material commodities area because of the tensions we're seeing. But eventually, the growth, engines that tie into the AI theme, et cetera, will come back. So I think from our point of view, while we're being aware of that, and we actually want to hire managers or strategies that are the best in the area that they're in. So if they're a manager that really focuses on quality growth, we don't want them to switch and all of a sudden follow a rotation. We want them to do what they do best. And I think what we're trying to do is construct portfolios that have that multi-factor and have different forces in them and diversification. So Frank does a lot of that work with the investment committee. Do you want to comment on that too?
Yeah, that's the idea. Is that our multi-manager approach, multi-factor diversification is central to the way we construct portfolios. We want to have managers that have been extremely successful in managing that factor and making sure that portfolios have exposure to these different factors. And yeah, to your point, Lauren, we've seen rotations from one to the other, from quarter to quarter. I think that's going to persist, and it kind of gives us confidence to kind of maintain this portfolios where we've got multi-factor exposure. As you know, we don't have any strong foresight of what the next quarter or the next year will look like, but having multi-factor portfolios will kind of allow us to capture some of these swings that we see from time to time.
Great points. I think we have time for one or two more questions, so I'll keep things moving. Although this was not a topic discussed, it seems crypto is
Mm.
ever a popular subject. So the question is, do crypto assets still belong in a growth portfolio?
I think Frank's addressed crypto at some previous sessions that we've had. From my point of view, it still represents a more uncertain part of the market, a more volatile area. So it's not a core part of a portfolio. We do have some people that want to explore that area. So it might be looked at as an opportunistic piece, but it's not a core part of what we're looking at.
Yeah, I would say it's part of the alternative sleeve of a portfolio for investors that can tolerate the volatility and the risks associated with crypto. And it's a growth oriented alternative strategy that obviously is growing in size. And we've seen the volatility, right? And we've seen that volatility in the last little while with Bitcoin, for example, that has had swings ups and downs through the crisis that we had in the Middle East. So yes, I think it does have a spot in an alternative sleeve as a growth component
At the right
Agreed.
size. Yeah, at the right size in a portfolio.
at the right size. Yeah.
Yeah.
Another benefit of having a multi-manager platform where you can execute in a flexible manner. Let's do one more question. So the question ties back to Frank's discussion about the state of private credit. Given recent headlines around private credit and liquidity, how are you assessing the balance between risk and opportunity in private investments altogether?
Yeah, it's gotten a lot more complicated in the last couple of weeks and months. I think at the core of it is the fact that a lot of these private credit strategies have exposure to software, and I think software has become it's been under the gun in terms of one of the sectors that is very disruptable if AI is as effective as it is. I think it's got a lot more complicated. I think AI is having a disruptive force across both public and private markets. And we're seeing it right now, and there's probably, unfortunately, there's more questions than answers. So it's an area where I think there's opportunities, but there's also a great deal of risks. And the fact that there's a lack of transparency in what's in these portfolios and the valuations gives us a degree of caution of becoming a little more aggressive in investing in that space. So this is kind of basically AI's, there's the good parts but also those other parts that are disruptive. And I think I highlighted that in our last webinar, and I think it will be a recurring theme that will work through markets for a while now.
Hmm. I think it's interesting because there are definitely opportunities across private markets as a complement at the right level in your portfolio to complement the core strategies. But I think just when you talked about the evolution of the private credit market, Frank, and how it's become more available to retail investors, you have seen some people really chasing that as an area they want to get into and not necessarily understanding the place it should have in a portfolio because there are those liquidity differences. So you need to make sure you're investing in something that, at a level in the portfolio that makes sense with respect to the liquidity differences, and it should be a longer term piece of the portfolio, et cetera. So I think there's real opportunities in the private markets, but within the full strategy for the portfolio. So, to talk about, again, with your advisor, to talk about what kind of strategy should I have overall, how much should be in core strategies, what am I going to, it sort of ties into your objectives that you have. How do you match your objectives for steady income to the core part of the portfolio and then have some other pieces that are alternatives that tie into your growth objectives. And that then you can have a good portfolio that takes advantage of some opportunities, but is aware of those dislocations that Frank is talking about.
Thank you, Frank and Krista, again. That brings us to the end of today's webinar. Thank you so much for joining us, and we hope to connect with you again soon. Have a good afternoon.
Thank you, everybody.
Thank you. Bye.
Bye-bye.